morning, everyone, and thank you for joining us for today's session, where we will be discussing the relaunch of 95% mortgages. My name is Stephen Smith, and I'm delighted to be joined, as always, by Ian Quayle and my colleague, Robert Kelly. Good morning to you both.
Good morning.
Stephen.
Before I hand over to Ian, I just, as usual, like to go over a few items so you know how to participate in today's event. You're listening to your computer's speaker system by default. But if you prefer to join over the telephone, please just select the telephone option in the audio pane and the dial-in information will be displayed. It is toll-free and the reception on the telephone is very, very strong. You will have the opportunity during the presentation to submit questions to Ian by typing your questions into the questions pane of the control panel. You may want to send your questions in at any time during this presentation, and we will collect these and we'll have the dedicated Q&A at the end of today's presentation. You can also raise your hand. There's a little raise hand button on your control panel. Please use this if you're having any difficulties with IT, and please do get in touch with me if you're having technical difficulties or any issues with sounds. I'm no IT whiz myself, but I will be able to talk to you over the chat and hopefully we can resolve any issues. We have also included the notes for today's session in the notes section of your control panel. I've noticed in previous sessions we've had that a lot of people do struggle to find the notes. We do have them available, so please do get in contact if you would like a copy during the presentation, but they should be there. As I say, there's a notes tab. I think it's called handouts. So if you click on the handouts, you can download them from there. Finally, we have also included links again in today's session for our LinkedIn page and YouTube channel, and also Ian Quayle's LinkedIn profile. Our LinkedIn page has details of all the webinars we run and news of our products. And on our YouTube channel, you can find recordings of previous webinar sessions, as well as a walkthrough of our online ordering portal. Anyway, that's enough from me, so I will pass over to Ian for the main part of today's presentation. Thanks, Ian.
Thank you, Steve, and thank you everyone for joining us this lovely Monday morning. Steve and I were just talking before the presentation, and Steve was being very kind, but in essence saying, you know, does the issue of 95% mortgages and their reintroduction generate any significance from a conveyancing perspective? And I hope I managed to persuade him that I think it does. There are two key themes really with regard to today. One, a sort of an explanation as to what the scheme is, and then two, how this impacts on conveyancers. And that second limb really we can subdivide. We can look at, do we need to tell clients about the mechanics of the scheme and about the potential downside of the scheme? And I think we do. And secondly, the idea of a 95% mortgage generates the spectre of a 5% mortgage. And again, as I've sort of bleated long and hard for many a year, 5% mortgages, sorry, 5% deposits in connection with a 95% mortgage can generate problems for sellers and problems for buyer clients. So we need to discuss that as well. So a lot of things to talk about. As Steve kindly mentioned, there are notes that accompany today's presentation. I'll also ensure that Stephen and Robert get a copy of the slides, and you're welcome to those slides, and happy to take questions as we progress or at the end, or you can send an email to either myself or Stewart Title, and I'll endeavour to assist. So lots and lots of things to talk about. As I say, first of all, why has the government all of a sudden decided to relaunch, reintroduce the idea of support in connection with 95% mortgages? The reason is, one, they have a track history, or there is a track history of assistance with regard to 95% mortgages boosting the property market. So whilst the property market at the moment probably doesn't need any boosting, perhaps when the SDLT window is closed, the idea of this product will ensure that there is some buoyancy in the market. Secondly, there is a sort of distortion in the market at the moment on the basis that you have problems with regard to first-time buyers getting into the market. And secondly, and this is probably a sort of hidden problem, the fact that there are people out there that would like to move but don't have sufficient equity in their current property to do so. So the idea of this is to try and encourage both of those sectors. So the government describes the scheme as the mortgage guarantee scheme sitting behind 95% mortgages as increasing the appetite for mortgage lenders for high to loan value lending, and this is a significant point, to credit-worthy customers. So it isn't back to open season in connection with poor credit risks as far as lenders and borrowers are concerned. It isn't sort of open season. Let's let anyone who wants a mortgage have a mortgage. It's not that at all. Now, there are some underlying problems with regard to this solution. Of course, there is a danger that the prevalence of a 95% mortgage facility will not only sort of bolster and boost the market, but will once again send property prices rocketing, assuming property prices stabilize when the SDLT window closes. In addition to that, there are some potential issues with regard to the mortgage guarantee scheme from a lender's perspective that might be transmitted ultimately to borrowers. Now, remember, the basic concept with regard to mortgages is that we're not required to give advice to clients about mortgage products. Remember that the idea is that we should be explaining to clients generalities relating to mortgages rather than specifics. But remember, one of the points that I've mentioned over these webinars and over the last sort of year or two, that if we've got vulnerable clients, if we've got inexperienced clients, if we've got products that are potentially significantly disadvantageous for clients, then we've got to come off the fence and give advice. So, you know, the best example I can give you of a situation where we come off the fence are problems associated with some of the sale and leaseback products that we've seen, and where clients have got themselves into terrible messes. In those circumstances, there is a requirement to advise the client that this is a commercially bad deal. Now, I'm not saying for the life of me that a 95% mortgage supported by the government mortgage guarantee scheme is a bad deal. But what I am saying is it isn't necessarily as good a deal as a traditional mortgage for two reasons. Firstly, the mortgage guarantee scheme is not free to lenders. Lenders are having to pay for this scheme, and therefore, as a consequence of that, there is a cost to the borrower. Secondly, the scheme has a finite lifespan. The mortgage guarantee that the government is providing to a lender lasts 7 years, which means once 7 years have been and gone, the lender will have some vulnerability that it didn't have during the scheme. And my concern is, in those circumstances, what is the stance of the lender? Now, when market conditions are good, when the economy is booming, hopefully the attitude of the lender is, well, fine, we can just run with existing product. But what is the position if the market is in a downturn? What is the position if the economy is bad? What is the position where we've got lots of borrowers that bought into this scheme that are now in arrears, etc.? Surely at that 7-year point, lenders will look at their vulnerability and say, hey, we've got to do something about it. So during the life of the 7 years, there's a degree of comfort that this scheme generates for lenders. And upon the expiry of the 7-year scheme, unless something else is in place, then lenders have a problem. Now, the reason for this 7-year duration is that statistics reveal that most borrowers default in the first 7 years of the term. After that, generally speaking, they steady the ship and they're all right for the remainder. But again, the point I would labour here is we just don't know what the future holds, and therefore we've got to be careful in giving advice to clients. If we look at the next slide, you'll see a number of points that I want to make. The new mortgage guarantee scheme is based on the Help to Buy scheme and previous schemes. It isn't compulsory for lenders to enter into the scheme. It is simply an option that's available to them to purchase a government guarantee that compensates them for a portion of loss in the event of repossession and sale. In other words, what they're doing is sort of guaranteeing their liability above the 80% loan to value threshold. Important to understand that the government is going to charge a commercial fee for that guarantee. And that's why I think that what we're looking at is a product that will potentially be expensive for our borrower clients. Now, if I'm sitting at the moment wanting to buy a property, sitting on a 4 or 5% deposit, and I look at this scheme and think brilliant, and I go and apply for a mortgage under the scheme, then again, there is a danger that, am I forced into buying this product? Now, luckily, some lenders are offering 95% mortgages out with the scheme on the basis that they don't like the idea of paying this commercial rate to the government for the benefit of the scheme. So I'm a little more confident that the lenders that are buying into the scheme can't offer entirely unreasonable products that borrowers are bound to commit to. If I'm in a situation where I need this product, I have a choice to buy a product that's within the government guarantee scheme, but there are other products outside it. And that gives me a degree of comfort. But where we were faced with a situation where the only way I, as a buyer, can proceed with a 95% mortgage is with a mortgage under the mortgage guarantee scheme, I'm stuck, aren't I? And where I'm stuck, I suggest there is vulnerability. And where there is vulnerability, in my view, there's a requirement to give advice. The evidence seems to suggest that what we're going to have is a boost in the market, a reinvigoration of the market, similar to the situation that arose between 2013 and 2016, when a similar scheme was introduced. It is generating a risk that is acceptable to government because government is getting a market rate for the guarantee, and it is not incentivizing irresponsible lending. The principles of the scheme, the overriding and overarching principles within the scheme are helping borrowers, making a process that's very simple for borrowers to access, making the scheme administratively simple for lenders, and ensuring that there is a division of risk between government and lenders. And the idea of all of this is, as I say, to bolster, to reinforce the current state of play relating to the residential housing market. Statistics reveal that the issue of sufficient deposit is potentially the largest burden for prospective buyers. So even beyond affordability of monthly mortgage payments, this is a major issue. But the scheme also attempts to address the issue of affordability of monthly mortgage payments by encouraging fixed interest rates for medium-term periods in an effort to try and ensure that first-time buyers are attracted to enter into the housing market and are to an extent protected from the vagaries of interest rates as a consequence. Important to understand that the fixing of interest rates according to the scheme provides borrowers with valuable extra certainty. And that's, I would agree, the case. Having said that, and importantly, the idea of fixing interest rates has a potential downside. If interest rates fall, obviously it has an upside if interest rates increase, but we just don't know what holds in the market for the medium to short term, never mind the long term. I mentioned in the notes a number of points that I would like now to sort of emphasize if I can. Remember the point that I made in my introduction. This scheme is targeted at first-time buyers, inexperienced conveyancing clients. And remember a point that I've labored on a number of previous occasions, such clients are vulnerable. And therefore, when giving advice in our standard engagement letters, etc., we need to be careful to explain to them the fact that if they're choosing a 95% mortgage with a mortgage guarantee scheme sitting behind it, it is likely to be more expensive than a 95% scheme that's out with the mortgage guarantee, or a traditional mortgage with a 10% deposit. As I mentioned in the notes, the idea is that the government is providing lenders with an option to buy in. The guarantee applies to 80% of purchase value of the guaranteed property, and the idea is that this is there to compensate lenders. So what we've got is borrowers being targeted and being incentivized, lenders being provided with a product that reduces their vulnerability and exposure, and therefore releasing the housing market if the housing market requires any more release. The scheme isn't just 95% mortgages, 95% mortgages combined with longer term fixed rates. And significantly important to understand that there is other support in addition to the scheme. And I mentioned on the slide here, the lifetime ISA, the help to buy ISA, and of course the SDLT window. The scheme is devised to prevent lenders from imposing charges to increase profits or offset costs from other parts of their business. But it is important to understand that the scheme is an economic scheme devised so that government doesn't sustain loss and lender doesn't save loss. In other words, the benefits and incentives have to be paid for. Lenders are required to take a 5% share of net losses over the 80% threshold, so that lenders aren't incentivized to offer poor quality loans to poor borrowers that have an inability to pay. Guarantees, I've mentioned, viable and valid for up to 7 years after the mortgage is originated. Up to 7 years, a lender could require the guarantee being in place for a period of time that is shorter than the 7-year maximum. Important to understand that compensation for losses and costs should be recoverable from the borrower in the event of borrower default. So, and this applies across sort of giving advice relating to mortgages generally. It is important that clients understand their duties and obligations to the lender, the situation as to what happens if they default, and the lender's right to repossess. And it's important that there is an understanding that where repossession takes place, losses and costs sustained by the lender can be incurred, and the borrower can be liable for those costs. The liability of the borrower isn't capped with the amount that the property is sold for on repossession. Absolutely essential that people are aware of that. And just an aside, many years ago, I used to do loads and loads of work relating to insolvency. And one of the tricks that I was taught about, which I saw in operation, was if you've got a client that is facing insolvency and their property is being repossessed, what they should do is notify their insolvency practitioner of the position relating to repossession and include any shortfall with regard to lenders' losses in the bankruptcy. The reason for that is if they don't, there is a danger that property is repossessed, lender sustains shortfall that is out with the bankruptcy, borrower is discharged from bankruptcy, but then lender pursues for the balance of monies that were outstanding in connection with repossession. I saw a number of bankrupts sustaining a nightmare situation of going through a bankruptcy, coming out the other side of a bankruptcy and starting again, only to be hit by a lender saying pre-bankruptcy or during bankruptcy we repossessed and we've taken a loss and you're now liable for that loss. Important to understand the issue of eligibility with regard to the scheme. Absolutely important that we understand just what the eligibility includes and who can be able to claim the product that is available. So the first point here is it is only available to residential property and not available for second homes and buy-to-let. It is available for new build and existing properties up to a ceiling of £600,000. And it must be taken out by an individual or individuals rather than an incorporated body. Most individual borrowers must be all eligible borrowers must be eligible under the scheme. And it has to be a property in the UK. The loan to value of the property must be between 91% and 95%. And it is important for clients to understand that there are dates specified within the scheme for a claim to be made. The eligibility criteria require that the mortgage is a repayment mortgage, not an interest-only mortgage, and there is a requirement on the lender to assess the borrower's ability to pay. So loan to income and credit score tests will exist for this product just as they will for any other. The whole idea of this is not to enable lenders to rejig their lending book. In other words, to restructure the riskiest part or the riskiest potential in connection with existing or potential future business, existing loan book or potential business, and that borrowers remain the beneficiaries of the intervention. So the idea is that our clients derive benefit, lenders can provide that benefit by way of a 95% mortgage supported by the mortgage guarantee scheme, but government is not being generous. It's creating the scheme, making the scheme available to lenders at commercial rates. The next thing that I want to talk about is something I've just touched on in connection with long-term fixed rate mortgages. The idea is that the product is accompanied by a 5-year fixed interest rate. And of course, that generates benefits, certainty being the obvious one, budgeting, ease of budgeting being another. But there are significant drawbacks, namely, what happens if interest rates fall? What happens if new products are out there? And what happens if our borrower client defaults with regard to this product and is required to revert to a standard variable rate, or there are provisions and penalties in the product that mean that the borrower is penalized for default? And again, here I think it's important that when we are looking at this product and the mortgage offer for the client, explain in general terms the potential problems. So I'm not asking and not suggesting that as a conveyancer, we become experts at this product compared to other lending products, or we start comparing lenders. What I am saying is that if there are provisions relating to a long-term fixed interest rate, we explain to the client in general terms the advantage, but also the disadvantage of the product and the circumstances. Now, I mentioned the fact that there are time limits for the scheme. Starts April 2021 and runs to December 2022. So the window of opportunity for this product is short. Do I think that the product might be extended, or the eligibility period might be extended? Possibly. I think it depends on demand and depends on the housing market. If the housing market remains strong upon closure of the SDLT window, then it may be that this product has a finite lifespan and is not extended beyond 2022. But who knows at this point in time? It is important to understand a number of other features relating to lender eligibility. And again, there are details in the notes. Any lender that is authorised under the Financial Services and Markets Act 2000 and 2012 that can offer regulated mortgage product in the UK is entitled to offer the product, assuming that they have bought into the scheme and that they are paying the appropriate payments to government as required. The important point here is that the government doesn't want to radically alter the lending market. The idea here is that what we've got are current lenders offering, in essence, a new product as a temporary measure. The scheme has a financial limit, in other words, it's capped, and the fees that are payable to the government for each mortgage are fees so that the government is not out of pocket. The scheme must be self-financing. That's why a number of lenders have looked at this and thought, well, good idea, 95% mortgage, fixed term interest rates, but we don't want the government guarantee. Why? We think it's expensive, or we want to do our own thing with our own product. National Savings and Investments are going to monitor the scheme and manage the scheme on behalf of the Treasury. And as I've mentioned in the notes, there is a cap with regard to government liability. A number of mainstream lenders have committed to the scheme, but it hasn't received unanimous approval. Oh, that's wrong, isn't it? Not necessarily unanimous approval. A number of lenders have decided to offer their own product. And what I've done in the notes is mention the product offered by the Yorkshire Building Society. There are others. The idea with regard to the Yorkshire Building Society product is that it mirrors some of the government guarantee scheme, but here only first-time buyers are eligible. Loan mustn't exceed 4.49 times income. Maximum loan limited to £500,000, and surprise, surprise, flats and new builds are excluded. Why? Yorkshire Building Society see flats and new build homes as potentially dangerous, creating some vulnerability for them with regard to this product, and therefore they've restricted its availability. Other lenders have offered similar sorts of deals with similar sorts of limitations. So, all well and good, all of that's fine. What should we be doing? One, I think, advising clients that these products may carry high interest rates or higher interest rates, that these products may carry higher administration or application fees. With regard to any scheme that is government backed, there is a cost to the lender, and the lender is bound to look at a means of recovering that cost from the borrower. And there is a potential for economic vulnerability for borrower clients. Again, as we're coming out of COVID and all the lockdowns that we've had, with the sort of positivity of a new economic boom, etc., all well and good, it sounds absolutely fantastic, but who knows the future? And again, it's important that clients understand that if there is a downturn, generally a downturn for a borrower client in particular, there is vulnerability with regard to these products. So clients should be advised about fixed rate mortgages, the fact that you're going to be paying more interest as a consequence of buying this product, and were interest rates to fall, the deal that appears currently to be a good deal or not too bad a deal might become a bad deal. Clients need to understand about the potential in the circumstances where they're unable to maintain their mortgage commitments, the risk of repossession, the risk of loss, and the risk of lender sustaining shortfall and recovering shortfall from borrowers by way of county court or other action. Clients need to be aware that there are a myriad of schemes out there, including the government-backed mortgage guarantee scheme. So again, we should be telling clients about opportunities to seek independent advice with regard to product. On the point of types of mortgage and suitability, again, I repeat, I'm not suggesting as a conveyancer that we start giving financial advice. I am saying that we explain to the clients the peculiarities of this product. And in doing that, there are a number of things to look at. Mortgage conditions, terms of the mortgage, acceptance of the offer, advising clients about each and every step in the mortgage process. Of course, I've mentioned to you before about advising clients of the dangers of relying on building society valuations. I suppose the point to mention here is that where lenders are lending 95% in a traditional context, their value would be looking to determine that the property has sufficient a value such that if the lender repossesses, it will get back its 95% advance. However, remember that the borrower is obtaining a mortgage product where the lender is vulnerable for 80% and then additional 5% of loss. So a valuer may well be looking at a property to determine that it is worth 85% of its purchase price on the basis that if the borrower defaults and the property is repossessed, the lender is going to get its money back. And the government is going to take a hit with regard to its guarantee. It is important to understand that there are lots of other schemes out there in addition to traditional 95% mortgages. I mentioned the Help to Buy scheme in the notes. Let's just have a look now at a particular segment of the marketplace, namely first-time buyers. Remember, it is important to ensure that when a client is purchasing a property, the client obtains appropriate advice relating to the product. It is important that the client has explained to them the nature of the transaction and the work that you do. In particular, the client needs to be aware of their duties and obligations to their lender, their status in circumstances where they default with regard to their obligations to the lender, and the need to ensure that a first-time buyer obtains a survey rather than relying simply on a lender's valuation. So on this slide, I'm saying to you with regard to first-time buyers, it is important to explain to the client the general position with regard to the conveyancing process, focusing in particular on the availability of mortgage and the mortgage being appropriate for the client, meeting the client's needs and being sufficient to enable the transaction to proceed. So when we focus in specifically on mortgages, should we be advising on types of mortgage? No. Advising about the availability of mortgage product? Generally, yes. Advice about sources of funds? Yes. Advice about the terms of a mortgage offer that is granted to the client? Definitely yes. I think with first-time buyers, we've got to be particularly careful about giving advice to clients in connection with mortgage default. We should also be advising clients of the difference between freehold and leasehold ownership, and we should be advising clients about risk associated with exchange and completion. And here I want to touch on a point that I think is significant with regard to this topic, which we haven't talked about as yet. If a client is buying a property with the assistance of a 95% mortgage, then clearly at exchange of contract, it is going to be agreed that the buyer client is paying a reduced deposit of 5%. Do you explain to buyer clients the position in the event of their inability to complete? And this is something that I find quite a difficult thing to talk to clients about, having many years ago being faced with exactly this situation. Buyer client exchanges contracts were due to complete. Week before completion, buyer's mortgage offer is withdrawn due to buyer client being made redundant. So buyer client ringing up and discussing with me the bad news and explaining to me that they understood that the 5% deposit that had been paid was lost. Being staggered to be advised, as per my letter of advice that had been sent out previous at exchange, that in addition to the loss of the 5% deposit, the buyer default triggers an obligation on the part of the buyer to pay the remaining 5% deposit to the seller, notwithstanding an inability to complete. So with regard to exchange and completion and the reduced deposit being accepted by a seller, from a buyer's perspective, we must warn the client about the potential danger in the event of buyer default at completion. Now, there's a point we're going to look at in a moment or two that's to an extent reduces that vulnerability, but it reduces that vulnerability slightly. It is important that the client is aware of that vulnerability. Remember what I said to you at the start of my presentation. There isn't a general duty to advise on commerciality and the commercial wisdom of a property transaction, unless the transaction is sufficiently a bad bargain that intervention would be appropriate for a reasonable conveyancer. But it may be incumbent on a conveyancer to go beyond the general position relating to advice if a client is inexperienced or the matter unusual. Now, certainly a first-time buyer is likely to be inexperienced and therefore is unlikely to have encountered mortgage products generally, this mortgage in particular, and again is likely to be unaware of the significance of a seller accepting a reduced deposit and the requirement potentially of a buyer having to make up the deposit to 10% in the event of buyer default. If I was acting for a buyer, I might want a special condition in the contract stating that the 5% deposit and its loss in the event of buyer default is all that can be claimed by a seller. But if I'm acting for a seller, I'm going to be hesitant, indeed very reluctant, to agree to such a provision. So this last point, I think, is important for first-time buyers, making sure that we're explaining the general position and explaining the specifics about the risk relating to deposit and the potential downside of the mortgage guarantee product. In the notes at page 10, I mentioned this case of Hagen Wright Hassel, 1994. Most solicitors will offer business advice and will, to some extent, try to protect clients from themselves. It would be wrong to hold there as an invariably legal duty to do so. But there will be situations in which it's clear to the solicitor that the client's commercially wholly inexperienced and is deluding himself. In those circumstances, there may well be a duty on the part of the solicitor to probe further. So that case isn't saying you've got to. And I'm not saying you've got to. I'm just saying there may be circumstances where is it appropriate to fire a warning shot across the bow of the client. Let's have a look now at the position with regard to deposits. And so far, I've tendered some advice with regard to buyers. How many of you, if I was a seller client selling to a buyer who has a mortgage under this scheme, would warn me about the disadvantage of accepting a reduced deposit? I think it is necessary to do so. And it is necessary to explain to the seller client we might have to pursue an action against the buyer to get the remaining 5% if that is our entitlement. I also think it's important in a circumstance where we've either got buyer or seller default and we're thinking about what to do with the deposit, to be wary of the fact that there isn't an automatic entitlement on the part of an innocent seller to retain the deposit, nor is there an immediate loss with regard to the buyer of a deposit where a buyer's in default. Section 49 of the Law Property Act 1925 gives the court a discretion as to what is to happen with regard to the forfeiture of a deposit or otherwise. And this discretion is available to determine whether the innocent party or the defaulting party retains or is paid back the deposit, depending on all the circumstances. I mention in the notes, just as an aside, and again I'll mention it now, be careful about ever agreeing a deal where a deposit of more than 10% is paid, on the basis that there is quite a bit of case law that says that such a deposit is a penalty and therefore unenforceable. I mentioned Section 49 of the Law Property Act 1925, and again, the idea of the courts is that they exercise a discretion as to what is to happen to the deposit, and in doing so must do justice that is required by the case. And I've given you a number of cases, Omar and El Wakil, 2001, and others, okay? And what these cases reveal is that the courts will look at all the circumstances to determine what is to happen. So just because a seller can sell and recover its loss with regard to an enhanced sale price doesn't automatically mean a defaulting buyer is entitled to get its deposit back. Just because a buyer has defaulted and has been unable to complete does not mean that the interests of justice mean that the seller retains the deposit. Each case turns on its own facts. Each case is explored by the courts and turns on the circumstances and what the requirements of justice permit. So let's just summarize this slide and the position with regard to deposits. Firstly, if you're acting on behalf of a seller and the buyer is suggesting they can only proceed with a reduced deposit, the seller should be advised as to the buyer's circumstances. Now, I remember in the olden days that it was possible to take out an insurance policy to cover the potential costs that a seller might incur in connection with a buyer default. I don't know, Robert, if you're listening, are such products still available?
Sorry, I've not seen one for a while, but yes,
No.
they were there. It's not something to be clear that Stewart Title offer, because it's not really a title policy. It used to get banks as well, used to effectively sort of cover it, didn't they?
It did, yeah. I thought there wasn't a product in the market, and I certainly was aware that it wasn't a defective title product, so therefore wouldn't be something that Stewart Title would offer. But I think the important point to labour here is that a seller client accepting a 5% reduced deposit must understand their vulnerability. A buyer client must also be aware of their position in the event of buyer default. And the more general position that I want to explore is if you're in a situation where you're acting for an innocent seller or a defaulting buyer, or vice versa, that you warn the client about Section 49 and about the fact that the position isn't entirely clear-cut and that it would be necessary to investigate what's gone wrong and why before determining what is to happen with the 5% deposit or 10% deposit that has been paid. So the cases that I've given you in the notes sort of explore a lot of the issues relating to deposits and advice that's given to clients in that connection. The last thing that I want to talk about today is just to sort of summarize some of the issues that we've explored so far, and hopefully to make time for questions before we finish. First of all, as I always state in these presentations, the key here is to do the simple things well. So where a client is proceeding with a 5% deposit that is supported by a mortgage guarantee scheme, it is important that you explain to the client the peculiarities of the product. So look at the mortgage offer, look at your instructions, and make sure you spell out to the client what this product does and what this product costs, and issues with regard to this product as opposed to other products. So where there are higher administration fees, higher interest rates, just flag up to the client that fact, and that there may be other products that are more suitable, generating a better advantage for the client than this one. But then telling the client to seek specialist advice. Where a client has chosen the product, where we're proceeding in a transaction, important again to set out to the client the terms of the offer. I mentioned inexperienced clients and first-time buyers. Absolutely essential that we're cautious, which leads me to a point that I often make. There's no such thing as a usual client in a conveyancing transaction. The SRA have heightened this, or mentioned this, or emphasized this in lockdown and beforehand. We have vulnerable clients. We have risk-averse clients. We have clients that don't fully understand the nature of a conveyancing transaction or the nature of a particular product. Important that we do a bit of hand-holding with regard to such clients. Important that clients understand the advice that we've given. And I concede that in the conveyancing process generally, giving advice about this particular scheme in particular, we could spend forever trying to explain duties and obligations. So I go back to first principles and say, make sure that our communications with clients are effective. We're telling clients about the peculiarities of the scheme, about their vulnerability, and we're asking clients to confirm to us that they understand, and we're asking clients to confirm whether they have any questions. The reason for this, quite simply, is as follows. I am worried that we've got a new product that potentially solves a problem with regard to boosting the housing market. But I am concerned that market conditions change, and that in 3 years, 4 years, or 5 years' time, we're looking at a webinar on the basis that there are now ambulance chasers sitting out there and claims farmers sitting out there saying, were you advised by your conveyancing representative or solicitor in connection with a transaction that involved a 95% mortgage? Important, I think, that we're just aware of that sort of situation arising, just as we've seen issues and problems arising with regard to ground rent and ground rent reviews for the last sort of 2 or 3 years in connection with residential leases that have been entered into in the last sort of 7 to 10 years going forward. So that's the point really that I want to emphasize. The other point to be aware of is that we could have clients that aren't first-time buyers, but are stuck. They own a property with very little equity. They want to move out of that product, of that property, into a new property, and the 95% mortgage guarantee is their way out. Again, in those circumstances, you can see a client saying, well, the only product I've got, the only way out of this pickle is to choose a 95% mortgage with a mortgage guarantee sitting behind it. Well, the point there is that there are products other than mortgage guarantee scheme backed products, and either a scheme product or a non-scheme product might be unsuitable for the client. You just don't know. So I think in both of those circumstances, first-time buyers and clients to whom this product is being marketed are potentially inexperienced and potentially vulnerable. My final point with regard to this is to be aware of making sure that when we are communicating with clients about deposits, that seller clients are aware of their vulnerability relating to 5% deposits, and so are buyers. So in a traditional transaction where a 10% deposit is paid, most firms will advise clients about the dangers associated with default at completion. I think that firms potentially are not aware of the additional problems associated with a 5% deposit. Steve, I'm conscious that I haven't seen any questions in the chat box, and I just wonder if there are questions and if we have 6 or 7 minutes to able to deal with any questions that have been generated.
Yeah, thanks, Ian. No, there are some questions that have come through actually. So just before we move on to those, just like to remind everyone that you can still submit questions through the questions pane in the attendee control panel. But if we move on to questions, I mean, one thing I wanted to ask Ian, and it's not particularly relevant, I think, for solicitors conveyancers, but the issue with advising on mortgages, would you say is there a bigger issue there in that? I mean, this is just my experience of it. I could be slightly off on this, but if you're an estate agent or a mortgage advisor or broker, you are trying to sell particular products, and you might not be particularly unbiased or neutral on what you're trying to do. So does that create an issue as well?
100%, yeah. The point there, Steve, is as a conveyancer or solicitor, you are entitled to give general advice about conveyancing products generally. So I can't recommend the Yorkshire Building Society 95% mortgage. I can say to you, Mr. Client, you need to get specialist advice about the raft of mortgage products that are out there. Okay, I can do that, but I can't say, you know, that's the product for you. Unless I've got trained and qualified and accredited members of staff that are giving mortgage advice. That would be separate, yeah? But generally, as a conveyancer, I can't choose a product or recommend a product. Where a client has chosen a product, I can explain to the client their duties and obligations relating to it. I can highlight to the client the fact that this product contains provisions that are potentially disadvantageous. So, hey, look, you know, that mortgage rate seems high. Those penalties in the event of early settlement are potentially onerous. Okay, and what I would do there is just heighten awareness. You do realize that your interest rate, although fixed for 5 years, is probably 1 or 2% above the norm. The penalties that you're required to pay in connection with early payment are quite onerous. So I can do that, Steve, but what I can't do is I can't say, hey, that's a great product and what you've chosen is a bad product.
Yeah,
I've just got to draw to the client's attention. It's this whole idea about commerciality relating to transactions. Now, if a client was obtaining a mortgage, a 95% mortgage from the Huddersfield and District Friendly Society, where the interest rate was 22% and the administration fee that needed to be paid to the Friendly Society was £5,000, and that there was a £3,500 penalty if the mortgage was discharged earlier than the 25-year term at any point during the 25-year term, then I'm required to step off the fence and say to the client, that is a shocking deal, don't do it. Generally speaking, what I'm saying with regard to this is we're just highlighting awareness.
Yeah, no, I think
that
that leads on to a follow-on question that just came in when you were talking there, Ian, and that's at what point does one stray into the regulatory mortgage advice trap? But I think you have kind of I think you've covered that really there. So I mean, thank you to Bharat for that.
What you do, you say the first thing is you say to a client, get independent advice. I'm not trained, I'm not qualified to give that advice. There are people out there that can go and get it. Okay. You can look at say a client comes to you with a mortgage offer and it is as ridiculous as the example that I gave you. You can come off the fence and say, that's a bad product. There's no way in a million years you should be signing up to that. But assuming it isn't bad, but it's a sort of standard-ish 95% mortgage, your job is to have a look at it and just say to the client, are you aware of this? Are you aware of that? Are you aware that there may be other products that might be better suited to you that will be offered to you on better terms?
Yeah, makes sense.
Okay.
No, thank you, Ian.
No problem.
A few more questions in. So I have a question from Mark. Mark says, you make reference to the scheme being similar to Help to Buy. He says, I don't undertake such work because of the silly hoops that have to be jumped through and as to how hopeless Homes England is. Is this scheme likely to have similar hoops?
No.
And if so, I won't be signing up.
No. The whole idea, Mark, is that this scheme, from a conveyancer's perspective, he said with his fingers crossed, should be relatively simple from an application perspective. So it shouldn't be particularly onerous from you with regard to getting involved in the scheme itself. You're at the back end of the process, and all I'm saying to you is you're just warning the client about the differences between this scheme and other mortgage products.
Yeah, no, makes sense. Thank you, Ian. But the following question from Mark, actually slightly separate, but have you ever been involved in an application for the return of a deposit, and is it an all or nothing remedy?
The position is that the court yes, I have, and the court has a discretion. So I have seen a situation where a court has divvied up the deposit. So yeah, you're entitled to 50% back.
Okay,
I've seen that.
Thank you.
Generally speaking, if the interest of justice requires the deposit to be paid back to the buyer, then all the money comes back. Are you with me, Steve? So
yes.
if a court says no, you're a defaulting buyer, but there are exceptional circumstances that mean justice permits the deposit to be paid back to you, then the deposit comes back to you. A judge isn't then going to say, but I'll divide it up so that the seller can retain 20%. But technically, that could be the case. It's whatever the interest of justice require. The court has an absolute discretion. Section 49(1), Section 49(2) of the 25 Act. And if you tell Mark also in the notes, there's a few cases that give you a flavour of how the court exercises its discretion.
Yeah, absolutely. Thanks. Yeah, I think that's towards the back of your notes, isn't it, today? So one of the latter pages there.
Yeah.
Thanks, Ian, and thanks, Mark, for that question. Wendy asked, I think of something you referred to in with the special condition. So she said, can you say again what you would want a special condition to contain in a contract when acting for the buyer?
Yeah, you could ask Steve, if you're acting for a buyer, that there's a special condition to state that the 5% deposit that is paid on exchange is the deposit in its entirety, and that the seller won't ask for the remainder of the deposit to be paid at completion in the event of buyer default. So I haven't got exact words. I haven't thought about the terminology that I would use, Steve, but that in essence is at the heart of what that special condition would involve. I'm saying to the seller, an exchange of contract, I'm paying you a 5% deposit. That's it. there's a standard condition that would need to be removed. And I can't for the life of me remember what the standard condition is. I'll check it. And if Sarah wants to drop me a note or drop you a note, Steve, I'll dig out the relevant standard condition that would need to be excluded.
That would be great. Thanks, Ian. I thought it was Wendy there with the question, but yeah, we can certainly get back to Wendy on that.
Yeah.
Just one final question that we have from Trish. Trish says, is this new scheme available to existing homeowners who wish to change their main residence?
It is, provided that it's less than £600,000 purchase price. It is, provided it's residential, and provided that the borrowers, if there's more than one, all meet the appropriate criteria. So it is aimed at first-time buyers and also people moving up the property ladder, as I mentioned, where they don't have sufficient equity in their current property to amass a 10% deposit on the property that they're buying. So the answer to the question that was raised there is yes, it is available for such buyers.
Fantastic. And just we're just a 1 minute past, Ian, though we have had another question
Fine.
come in. I think this is actually very similar to one of the questions we already had, Ian. So I will say, but we might have to get back to Jessica. Jessica's asked, would Ian be able to give us a proposed special condition to amend the deposit position, please?
I'll
think we might need to.
Yeah, I'll see what I can do, Steve. I'll see what I can do tomorrow. Yeah, more homework, perfect. Steve. Eh? No rest.
Absolutely, it's piling up for you, Ian. Absolutely.
Yeah, it is. It is.
Yeah.
Never mind. Yeah, I'll see if I can do that. That's fine.
Thank you, and thanks, Jessica, for that.
Yeah, thanks, Jessica.
I think that's everything with the questions. I don't know if there's anything you wanted to say just to sum up, Ian. But...
No, well, Steve, just again, thank you very much for you and Robert for organising this. Just a reminder, anyone that does any commercial property work, we've got a great webinar with Tim Calland at Maitland Chambers looking at commercial leases and COVID. I think that's next week, isn't it, Steve?
It 20th? Is, yeah. Thursday, I think, yeah. Thursday, yeah.
That would be interesting. And again, I'm really looking forward to that. And thank you, Steve and Robert, for organising today. I hope it's been it's one of those things you first look at it and think it doesn't really matter. But I think there are issues for conveyancers, some issues that are really existing issues with regard to advice related to mortgages generally in any event and deposits in any event, but also some specifics arising from the peculiarity of the product. So hopefully it's been of use and of interest to delegates that have attended. So thank you everyone for coming along. Thanks, Steve, for hosting this, and thanks, Robert, for organising it.
Just before we finish, Ian, sorry to interrupt, just to confirm that there is an email going out with details of that commercial one. Should be hitting people's inboxes later today or tomorrow with all the booking details on there.
Yeah. Any of you that haven't heard Tim speak before, great guy, and the case that we're looking at, really interesting with regard to issues associated with rent and COVID. So if you're doing commercial lease work, or anyone in your firm is doing, it's probably well worth a listen. Thanks for that, Robert.
Yeah, thank you. Thanks, Ian, Robert. Yeah, just a reminder that if you do have any questions that you weren't able to ask in today's session or you think of afterwards, please do get in touch. There will be an automated email that you receive after this, and the replies will come directly to myself. Apart from that, just leaves me to say thank you to everyone for attending, and have a great rest of your day. Thanks, everyone, and goodbye.